During this week, we saw a lot of things, and we had a few emails that came in, probably about half a dozen, maybe a little bit more, about what is going on with the market. Everything from earnings reports that came out earlier in the week, rate hikes that we, of course, had to see and digest a little bit, what was happening on Wednesday and Thursday, and then, of course, the job reports that came out this morning, which might have thrown everything into a conundrum. As I mentioned, we had about half a dozen emails that came in from power options users and concerned investors this week about current market conditions and what is being shown in the market sentiment tool. This one email from Len kind of summed up most of those topics. And Len sent me an email the other day. He says, right after the rate hike, of course, he says, I was surprised that Powell didn't go 50 basis points to show the market that the Fed was serious. That's his opinion. My question is, I'm seeing the NASDAQ going crazy high. This was Thursday morning, I believe. But the market sentiment tool on power options the sentiment seemed that the market hit bottom last October and we're now in a bull market. Yet there's still inflation at 40-year highs. They're showing a little bit of improvement. Businesses are starting to lay off. We're seeing that almost every day in the finance news about a big company that's laying off another 1,000, another 2,000, another 3,000, another 5,000 employees. And the power options market sentiment tool shows a bearish sell warning. It hasn't gone to a strong sell warning yet, but it is at a bearish sell warning. And then the big companies, Apple, Google, Amazon, Ford, Starbucks, and Qualcomm, all reported Thursday night after the market close. Len says also usually the last bull market leaders, tech wouldn't be the sector to lead us out, but maybe one of the poor performers like cyclicals, staples, and industrials. What am I missing here, or am I? And many of you probably have had these same thoughts. So I have my thoughts, but as always, I go to the master because he's usually right more often than wrong. So I asked Ernie specifically, what are your thoughts on Len's question? And Ernie gave me an answer. Ernie's thoughts were similar to Len's regarding the rate move. Ernie was disappointed that Powell didn't go for the half point instead of the quarter point. Ernie felt the half point would have been better to crush inflation. He feels that Powell is trying to kill inflation without killing the economy. What he did was great for the market by only moving it the quarter basis point, but it risks that inflation may not continue down as strongly as others hoped. Ernie's other thought is the 1.3 trillion infrastructure spending has not really started yet. That could lead to even more inflation and be very inflationary as well. Now, Ernie continued on regarding the market sentiment, and this is what our thoughts are all the time, or how we comment on this. We've got 5 bearish, 8 neutral, and no bullish indicators of the 13 indicators that are used for the broad market conditions. The market sentiment on February 1st is based on the last few weeks run in prices. So historically, when we see some of those specific indicators move up drastically or hit a certain fence range or hit a certain point, historically, those start to fall. And how do they start to fall from the levels they're on? Well, the market pulls back as a whole. So it appears that the market is slightly overbought, and that's what the market sentiment is kind of leaning us to. Now, this is what you hear me state when the sell warnings come up. Ernie's thoughts are when he sees a sell warning come up, he's going to take some profit on some of the more leveraged positions that are at risk that he has to lighten up the load a little bit. He's going to write some covered calls against maybe stocks he owns, but more likely against the married put positions that he has as well. And he actually rolled up long calls in the short term. What does that mean? Ernie has bought several long calls at the beginning of the year. We mentioned this in previous webinars on things such as the 2XQQQ and some other double ETFs on broad market indicators. Well, when you have these runs up, he wants to lock in some of the profit on those positions, same as we might roll up the put in a married put trade. So that's what he's referring to about rolling up the long calls. Take some of the profit on the table, reduce some of the potential exposure or risk on that position, or maybe close them if he's hit his goals for the trade. He mentions that Tuesday was a great tech rally. It did allow Ernie to bulletproof more than half of the positions in the Fusion portfolio for the married puts. He's got 7 positions open. 4 of them are now bulletproof. I've got 3 positions open. 1 of them is bulletproof, and the other 2 are profitable as well. I just haven't made adjustments to those. We'll talk about that maybe a little bit later. And my follow-up was, I had similar thoughts as Ernie. He had mentioned that I should have rolled up some of my puts in the Fusion portfolio that are performing well. But I did hesitate. I feared of moving the put up too high and seeing a pullback and having the put too deep in the money and not being able to do other adjustments. I was correct. Should have moved the put potentially on NEM and possibly on Schwab as well, or moved the Schwab position down, and then I'd be able to move it back up now. But I was afraid of getting caught. So Schwab and NEM could have been adjusted. They both pulled back 2 and 3% today. And I should adjust Annette soon because I did make an adjustment on that one to lower the break even, and it's now exceeded my expectations after I did that 10 days ago. NEM is the one that's taking the hit, and my portfolio is down another 5.3% today. It's down about 5 points in the last 3 days. So yes, I should have moved my put up the 52.5 put I had when the stock was at around 54, moved it up to the 55, further bulletproof the trade to lock in higher profits. I didn't. I'm going to let my call expire worthless today, and I'm going to readjust the position on Monday or Tuesday. Schwab is now performing well, moving back up after a big decline. And Annette, well, it was down to 120, and I moved the put down to lower the cost basis. Now the position's at a profit because it was up to 133. Now it's at 131 as well. Now, as we saw Thursday after hours leading through Len's position, I answered in this after the market closed in about half hour. We saw what happened. Amazon was down about 6.2% after hours with the revenue beat, but an EPS miss. Google was down 4% with almost the same results. Ford was down 6% after the Q4 and yearly profits were missed. Starbucks was down 3.3%, but still held above 105. I think it ended the day around 104.50 or so. I had mentioned that I wish I would have continued that married put I closed back in August, but I had a 9% return in 3 months, so I definitely met my goals for the target of the radioactive trading married put in my portfolio. And Qualcomm, of course, was up 1%. But again, then today the jobs report came out, which probably means Powell's going to have to think double about what he did the other day because he's hoping that the economy itself would slow down a little bit and not be as hot, but the jobs report today pointed to something different. So where does that all leave us? Well, we're still with a sell warning. We'll check that in a little bit to see where we stand. It'll update in just about 10 minutes or so. The SPY was down around 1% today. QQQ was down around 1.6, 1.7. Interestingly enough, the VIX was down about 1.5% as well. It's always interesting to me when the market pulls back after a high that we've seen, whether it's related to news, fear of inflation continuing, as Len had mentioned, now the jobs report coming out, fear of a hot market making Powell react differently than to what he did do, the other day. But the fear gauge is dropping also as the market pulled down. So it's always interesting to see that because, there's a little breathe today, a little bit of breath, a sigh of relief, a sigh of pulling back, but at the same time, the fear gauge drops slightly. But the keys are always the same in different market conditions. And you've heard me say this, maybe ad nauseum, but that's how I've been able to stay with power options and also stay in the market and stay profitable. Keys are always the same in these market conditions. Practice proper position sizing. Watch the market sentiment tool for keys, gauges, indicators of a shift that might be coming. Perhaps lighten up if you're concerned on some of those more leveraged positions that you have profits in, or maybe even a small loss so that loss doesn't get away from you. Sell premium, as Ernie mentioned, on stocks, or protect some of those other bigger positions with a hedge if you're concerned with the market downturn, whether you're just buying puts against that position directly, or buying puts against broad-based SPY, QQQ as a hedge, or maybe even calls on the VIX if the prices have come down a little bit. I'd like to see them a little bit lower, maybe in the 16 range before I start buying calls on the VIX again. But that also depends on market conditions and my expectations. And as always, send me your questions of your fears, concerns, trades as we go through the next week and into the next months of 2023. So those are our thoughts on the current market conditions, things that we've seen this week, market events, and more. Do you have any comments? Go ahead and send those in the question pod now in the live webinar, or of course, when this gets posted, comment on the YouTube video and let us know your thoughts so we can let us know our thoughts on your thoughts as well.